As of 10:50 a.m. Eastern Time, with the market live and trading, shares of Chipotle Mexican Grill, ticker CMG, are struggling to find direction, trading at $31.75. That's a fractional gain of just 1 cent, or about 0.03% for the day. The stock has been bouncing in a tight range this morning, between a low of $31.41 and a high of $32.04, all on pretty significant volume of over 7.2 million shares. This lack of movement, this attempt at stabilization, is what happens after an absolute catastrophe. The expectation that this stock could just shake off bad news and keep climbing has met a brutal reality. The company's core growth engine is sputtering, and the market is terrified. The common belief, the narrative that has held for years, is that Chipotle is the undisputed king of fast casual. It's seen as a premium brand with unmatched pricing power, a cult-like following, and a clear path to growth through new stores and digital Chipotlanes. Investors believed the company was immune to the pressures hitting lower-tier fast food chains. But the reality, delivered in its late October third-quarter earnings report, was a cold shock. That report showed the narrative is, at least for now, broken. The company didn't just miss expectations, it confirmed investors' worst fears about the high-end consumer. Let's look at the damage from that recent earnings release, because it explains everything we're seeing in the stock's behavior. The stock didn't just dip, it plunged, collapsing over 20% in a single session. This wasn't a sell-the-news event. It was a fundamental reevaluation of the entire company. The headline numbers looked okay at a glance. Revenue was up 7.5% to $3 billion. But that was almost entirely driven by the company opening new restaurants. The critical metric, comparable restaurant sales, was up 0.3%. Which is pathetic. And buried within that number was the real poison, customer traffic. The actual number of people walking in or ordering online decreased by 0.8%. This is the third consecutive quarter that Chipotle has had to cut its full-year guidance. They are now telling the market to expect comparable sales to decline in the low single digits for the full year of 2025. For a stock that trades at a high-flying valuation, negative traffic and negative comps are a death sentence. Management tried to explain it, pointing to persistent macroeconomic pressures. But the detail they gave was even more frightening. CEO Scott Boatwright specifically called out a significant pullback from customers in the 25 to 34-year-old demographic who earn less than $100,000 a year. Why does this matter? Because that specific group accounts for an estimated 40% of Chipotle sales. These are the people who are now crushed by the resumption of student loan repayments, persistent inflation in rent and groceries, and stagnant wage growth. They are choosing to cook at home rather than buy a $15 burrito. Chipotle's premiumness has suddenly become its greatest liability. This traffic decline is creating a vicious cycle. The company is also facing intense margin pressure. Its operating margin actually fell from 16.9% to 15.9%. This is because their costs are going up, wage inflation for their workers, and higher food costs, especially for beef, which was also impacted by new tariffs. In the old days, Chipotle would just raise menu prices and everyone would pay them. But now they are caught. If they raise prices further to protect their margins, they risk accelerating the traffic decline and pushing even more of their core customers out the door. If they don't raise prices, their profitability gets squeezed. They are stuck, and the market knows it. This brings us to the short seller interest in the stock. When you see a high-growth name fall this hard, the first question is often about short activity. Is this a coordinated attack? Is a short squeeze possible? Looking at the data, the short seller story here is not what you might think. The short interest is currently around 27.4 million shares. But as a percentage of the float, that's only 2.09%. That is not a high short interest. It's actually quite low and doesn't suggest a crowded short trade. Furthermore, the cost to borrow shares, the fee that short sellers have to pay, is incredibly low at just 0.39%. This means it is very cheap and very easy to bet against the stock. The days to cover, which measures how long it would take all shorts to buy back their shares, is a tiny 0.66. With today's high volume, they could cover in a matter of hours. So what does this tell us? This is not a meme stock. This is not a crowded short squeeze setup. The bearish case for Chipotle is not a technical one. It is a cold, hard, fundamental one. The people betting against this stock are not looking for a quick pop. They are looking at the negative traffic, the shrinking margins, and the consumer pullback, and they are making a valuation-based bet that this stock is still too expensive even after its collapse. Some analysts noted the stock was still trading at a forward price-to-earnings ratio of over 30 times, which is incredibly rich for a company that is now guiding for a sales decline. We did see some spikes in fails to deliver back in September, which can sometimes hint at settlement issues, but the numbers were not large enough to indicate a systemic problem. For a retail investor, this is critical to understand. You can't just buy this stock hoping to squeeze the shorts. The shorts aren't trapped. They are, for now, winning the argument. If you're looking to track this yourself, you can find short interest data published by the exchanges, like NYSE, twice a month, or get more frequent updates from data providers like Fintel. But I would tell you to pay more attention to the borrow fee rate. If that 0.39% rate suddenly spikes to 10%, 20%, or 50%, it tells you the demand to short the stock is suddenly overwhelming the supply of available shares. That would be a signal of intense new bearish pressure. Given the low 2.09% short interest, do you think the bears are right that this is a valuation problem, or are they missing a long-term opportunity? Let me know your take in the comments. This shift is palpable on financial forums and social media. The discussion around CMG is not the to-the-moon hype you see elsewhere. It's a much more sober and, frankly, worried debate. You see long-term holders asking if the growth story is permanently over. You see value-focused investors trying to figure out where the bottom is, with many, like Citi analyst John Tower, warning that it's difficult to call a bottom given the multitude of factors weighing on demand. The general consensus is that the company's premium brand is being tested in a way it never has before. So where does Chipotle go from here? The company is not standing still. Management's plan is to double down on restaurant execution, sharpen its marketing message to focus on value, and accelerate menu innovation. The expansion plan is still aggressive, with 315 to 345 new restaurants slated for 2025, and 80% of them will feature the all-important Chipotle drive-thru. The bull case rests on these new stores, combined with future catalysts like international expansion into Mexico, planned for 2026, and a bigger push into catering, to reignite growth. Some institutions were even buying the dip before the earnings report, with firms like Eastover Investment Advisors adding shares in the third quarter. But the risks are immense. The primary risk is that the consumer simply does not bounce back. If these macroeconomic pressures are the new normal, Chipotle's old model may not work. The company is now in a street fight with every other restaurant, from McDonald's to local pizza joints, for a share of a shrinking discretionary pie. And we cannot forget the ghost in the machine for this company: food safety. Chipotle's model, which relies on fresh, unprocessed ingredients, also makes it uniquely vulnerable to foodborne illness outbreaks. An E. coli or norovirus scandal, like the ones that crippled the company years ago, would be absolutely devastating in this current environment of weak customer trust. Comment below what you think is the biggest reason for the traffic decline. Is it Chipotle's prices, or is the consumer just completely tapped out? In the end, the story of Chipotle has transformed. The expectation was that of a flawless growth stock, a technology-driven restaurant that had cracked the code. The reality is that Chipotle is a cyclical, consumer discretionary company that is deeply exposed to the health of its core customer. The stock is now at a crossroads. Is this a generational buying opportunity to get a best-in-class brand at a massive discount? Or is it a falling knife, a premium product that has lost its customer in an economy that can no longer afford it? The data, from negative traffic to shrinking margins, suggests that this is not a simple dip to be bought. The company has to prove all over again that it can bring people in the door.